Basic insurance concepts in managing risk. By the end of this lesson, you should be able to describe different types of risk, explain the difference between a peril and a hazard, discuss various methods for handling risk exposures, and understand numerous insurance-related definitions. We define risk as the possibility of loss, and this is the possibility, not the probability. Possibility meaning something could occur, it just cannot be measured, as opposed to probability, which suggests an element of measurability. We differentiate between pure and speculative risk. Pure risk is defined as a situation in which there are only possibilities of loss or no loss. Speculative risk is a situation where either a gain or a loss is possible. Fundamental risk is a risk that affects a large segment of a society at the same time, generally the responsibility of society. A particular risk is a risk that affects only individuals and not the entire community. The responsibility of the individuals exposed to them. Personal risk is risk involving the person, such as premature death, old age, pure health, and unemployment. Property risk is the risk involving loss or damage to property. And liability risk deals with the liability for injury to others or damaging their property. We define a peril as the cause of the loss. For example, if your house burns because of a fire, the peril or cause of loss is fire. If your car is damaged in a collision with another car, collision is the peril or the cause of loss. Some common property damage perils are listed below: fire, windstorm, tornadoes, theft, lightning, hail, earthquakes, and burglary. We define a hazard as a condition that creates or increases the chance of loss. Three major types of hazards: physical hazards, moral hazards, and morale or attitudinal hazards. A physical hazard is a physical condition that increases the chances of loss. Icy roads, defective wiring, defective door locks, that would be three particular physical hazards. Moral hazards deal with dishonesty or character defects in an individual that increases the frequency or severity of loss, such as faking an accident, submitting a fraudulent or inflated claim, and intentionally setting a fire, arson. A morale or attitudinal hazard deals with carelessness or indifference to a loss because of the existence of insurance. When the implication is that someone else will take care of this if I'm negligent, they may not exercise the same standard of care as they would in other situations. So for example, leaving car keys in an unlocked car, leaving a door unlocked, or changing lanes suddenly on a crowded interstate. As far as risk control, we define this as those techniques that are designed to minimize, at the least possible cost, those risks to which a firm is exposed. It's composed of these main activities: risk prevention, retention, reduction, avoidance, and transfer. Risk prevention is the process of reducing the probability of a loss. For example, building fire-resistant structures, installing security devices in your home, scheduling annual physicals, and using automobile seatbelts. If a loss occurs, an individual or firm will pay out for the loss of whatever funds are available for the time. In planned retention, or self-insurance, involves the conscious and deliberate assumption of the risk. Unplanned retention occurs when an individual firm does not recognize the risk exists and unwittingly believe that no loss could occur. On risk reduction, that's the process of reducing the severity of loss either before or after the loss occurs. For example, when you install a standpipe system, which is a fire hose or fire standards to hook up to for the fire department, in a building, it will aid the fire departments in getting the fire out should the building catch fire. So it's assisting them and will reduce the amount of the fire and amount of damage from the fire. On risk avoidance, that's the conscious decision not to expose oneself or one's firm to a particular loss. So for example, if you rent a home instead of owning a home, you don't have to worry about the home burning down because you have no ownership or equity interest in that property. Another example, deciding not to travel by air avoids the risk of loss due to an airplane accident. Risk transfer, that is payment by one party, the transferor, to another party, the transferee, or the risk bearer. The transferee agrees to accept the risk that the transferor desires to escape. So types of these risk transfers can be hold harmless agreements, incorporation, diversification, hedging, and insurance. Let's talk about hold harmless first. That's a provision inserted in many different types of contracts that transfers responsibility for some types of losses to a party different than the one who would otherwise bear it. Incorporation. It's a legal form of business intended to separate the assets and liability of the business from those of the individuals involved. Diversification. A process of pooling risk with different correlations in order to spread the risk and result in a reduction of total risk. For example, a firm with 2 manufacturing facilities that are geographically diversified, one in one part of the state and one in another state. Should an earthquake damage one of these, it's highly unlikely that the second facility far away be damaged in the same event. Hedging. That's the process of transferring a speculative risk. For example, a farmer who desired to protect himself from price changes between the time he plants a crop and the time that he harvests a crop could sell a futures contract to a speculator. If the price of the farmer's crop declines to the value of the futures contract, will go up to offset the loss. And insurance. An economic device whereby the insured substitute a small certain cost, which is referred to as the premium, for a large uncertain financial loss, the contingency that's insured against, and that's sent to an insurer. It is an economic device for reducing and eliminating risk through the process of combining a sufficient number of homogeneous exposures in a group in order to make the losses predictable for the group as a whole. Non-insurance transfers. That involves shifting the risk from one part to another. So subcontracting, licensing, and franchising are 3 examples of that. Now, as far as the insurer's perspective of an insurable risk, there are certain characteristics they look for. The first being a large number of homogeneous units. Second, accidental and unintentional losses from the point of view of the insured. And they are definite in time and place, measurable, and of sufficient severity to cause economic hardship, and also typically non-catastrophic. Now, insurance works well when the balance is maintained between the number of insured exposures and the number and severity of those losses in the pool. Insurance will have difficulties when more and more people collect on their policies. The frequency and or the severity increases. That'll raise that outflow of dollars from the insurance company. Therefore, the price must rise in order to maintain stability of the company. Fewer people will buy as a result of that price increase. The risk premiums increase, and then the pool shrinks in size as those customers defect to another and more cheaper carrier, and the cycle starts all over again. This can result in small pools, many collecting, and unaffordable premiums. Now, from the insured perspective, an insurable risk, some of the characteristics will be, does the exposure warrant protection? Is the probability of loss low? How much is the premium for the loss probability exposures? The measurement risk comes by looking at the probability of some risks that can be measured precisely. So for example, if you take out a deck of cards, the chance of you pulling the ace of spades is exactly 1 in 52. Other types of risks are impossible or very difficult to measure. So the chance you'll be hit by lightning this evening. The law of large numbers is very important in insurance. The greater number of exposures, the more closely with the actual results will approach the probable results that are expected from an infinite number of exposures. If we toss a coin 10 times, we'll probably not get 5 heads and 5 tails. But if we toss that same coin 10 million times, we will probably get very close to 5 million heads and 5 million tails. There's a concept called inverse selection, and that is defined as the tendency of persons with a higher than average chance of loss to seek insurance at standard rates, which if not controlled by underwriting, results in higher than expected loss levels. Some examples are high-risk drivers who seek auto insurance at standard rates, and persons with serious health problems who seek life or health insurance at standard rates. More definitions for you. Individual policies, usually owned by the person or entity who is the insured. Group policies provides coverage to more than one person under a single contract that's issued someone other than the person insured. A certificate of insurance is a document usually issued by the insurer evidencing coverage. The applicant, the person or entity that applies for insurance coverage. The policy owner. Once the insurance policy is issued once the policy is issued, the applicant becomes a policy owner. The insured, usually but not always the policy owner. For example, in life insurance, there can be different ownership depending on the nature of the insurance purchased and the intent. We'll talk about mortality versus morbidity. Mortality can be defined as the condition of being mortal, the proposition of deaths to the population as a whole. Morbidity can be defined as the incidence and severity of sickness and accidents in a well-defined class of persons. Here's a mortality table to look at, and we don't expect you to memorize each of the individual numbers, but please become familiar with how the numbers trend. When we look at the life expectancy on the left side of the screen for a male, the first column, we talk about deaths per 1,000 people at a given age, the numbers on the right. You will see that the number of deaths increase with the increase in age. And conversely, the remaining life expectancy goes down the older that we get. The same goes for the right half of the chart there. Both the deaths per 1,000, they trend the same way as the males. As we get older, the frequency of death incurs. And the final column there, the remaining life expectancy decreases with the older that we get. So to summarize, in this lesson, we talked about different types of risks, perils and hazards, methods for handling risk exposures, and numerous insurance-related definitions.